How to use implied volatility rank for ETF options trading. Have you ever wondered how to make smarter decisions when trading exchange-traded fund options? One powerful tool that can help you is implied volatility rank. This tool compares the current implied volatility of an exchange-traded fund to its range over the past 52 weeks. It is expressed as a percentage from 0 to 100. A high implied volatility rank indicates that the current implied volatility is near the highest levels seen in the past year. On the other hand, a low implied volatility rank suggests it is near the lowest. This measure is essential for understanding whether options on that exchange-traded fund are relatively expensive or cheap based on market volatility expectations. When trading options on exchange-traded funds, the implied volatility rank can guide your buying or selling decisions. For instance, when the implied volatility rank is high, options premiums tend to be more expensive. This is because the market anticipates larger price swings. In such situations, it often makes sense to sell options or use strategies that benefit from a decrease in volatility. Examples include credit spreads or selling covered calls. Conversely, when the implied volatility rank is low, options premiums are cheaper. This environment is often more favorable for buying options or using debit spreads, aiming to profit from an increase in volatility or directional moves. To calculate the implied volatility rank, you take the current implied volatility percentage of the exchange-traded fund. Then, subtract the lowest implied volatility percentage seen in the last 52 weeks. Next, divide this number by the difference between the highest and lowest implied volatility percentages during that period. Finally, multiply the result by 100 to get a rank between 0 and 100. For example, if an exchange-traded fund's implied volatility has ranged from 15% to 30% over the past year, and the current implied volatility is 27%, the implied volatility rank would be calculated as follows. Take 27 minus 15, then divide by 30 minus 15, and multiply by 100. This would yield an implied volatility rank of 80. This indicates that implied volatility is relatively high compared to its historical range, suggesting options premiums are expensive. In swing trading with exchange-traded fund options, using the implied volatility rank can help you identify favorable entry points. High implied volatility rank environments may present opportunities to sell options and collect premiums, expecting volatility to revert lower as the swing trade progresses. On the flip side, low implied volatility rank situations might be better for buying options to capture potential volatility increases or directional moves during the swing. It is also worth noting that exchange-traded funds generally have lower implied volatility than individual stocks. This is due to their diversified nature, which makes them less affected by binary events like earnings reports. Therefore, monitoring the implied volatility rank is especially important to gauge when volatility is unusually high or low for the exchange-traded fund. This helps traders decide whether to initiate options positions that align with their market view and risk tolerance. Using the implied volatility rank in exchange-traded fund options trading involves assessing whether current implied volatility is high or low relative to the past year. When the implied volatility rank is high, it is often better to sell options to capitalize on expensive premiums. When it is low, buying options can be more beneficial due to cheaper premiums and potential volatility rises. This approach allows exchange-traded fund options traders to make more informed decisions based on the volatility environment, which directly affects option pricing and potential profitability.